The U.S. economy is on the verge of collapse. Inflation is out of control, housing is unaffordable, and debt is at an all-time high. But here's the shocking truth. This isn't just bad luck. It's the Federal Reserve's calculated actions. After keeping interest rates painfully high, they've suddenly slashed them, claiming it's to cool inflation. But is that the whole story? Or is it part of a plan that benefits the wealthy while pushing the rest of us toward financial ruin? Stay tuned until the end, where we'll expose what's really going on and what it means for your financial future. In the last couple of years, the Federal Reserve has hiked interest rates 11 times. Why? To combat inflation. But today, after holding rates at 5.25 to 5.5% for about a year, they've made a new move, a surprise interest rate cut. Yes, the Fed has announced a significant 0.5% rate reduction, a larger-than-expected policy shift. They're framing this decision as a necessary step to address a weakening labor market and the fact that inflation is finally cooling. In fact, last month's Consumer Price Index, CPI, reported inflation at just 2.5%, the lowest we've seen since February 2021. But don't be fooled by the numbers. This is not just about inflation or employment, it's about control. Now, let's dive into what this rate cut actually means, and more importantly, how it's going to affect you. Whether you're a seasoned investor, a first-time home buyer, or someone just trying to keep up with your credit card bills, this change has real consequences. Before we discuss those impacts, though, let's take a moment to truly understand what a rate cut is and why it matters. If you're not familiar with financial jargon, hearing the term rate cut might feel like listening to a foreign language, but let me break it down for you in simple terms. When we talk about a rate cut, we're referring to the Federal Reserve lowering the federal funds rate. This is the interest rate at which banks can borrow money from the Fed overnight. In turn, it influences nearly every other interest rate in the economy, from mortgages to car loans to credit cards. Why does this matter to you? Because when banks borrow money more cheaply, they pass those lower costs on to you. In theory, this makes borrowing money for things like buying a home or starting a business more attractive. But it also has its downsides, as you'll see. When interest rates go down, it encourages spending. That sounds like a good thing, right? More spending equals more economic growth. However, when everyone rushes to borrow more money, it can lead to dangerous levels of debt, rising asset prices, and, believe it or not, future inflationary spikes. But why now? Why is the Fed cutting rates at this moment? After all, for the last year, they've been keeping rates high to slow inflation, which shot up during the COVID-19 pandemic. So why change course? Well, there are a few reasons. First, inflation has cooled. Second, the labor market is starting to show signs of weakness, and the Fed is under pressure to stimulate the economy. Jerome Powell, chair of the Federal Reserve, mentioned last month that the time has come for policy to adjust, and today's rate cut is that adjustment. But the real question is this really a step toward economic recovery, or is it just another band-aid over deeper systemic problems? Why this matters for you. Let's talk about what happens when the Federal Reserve cuts rates. Historically, lower interest rates are viewed as a boon for the stock market. In fact, according to data from Schroders, 12 months after a rate cut, the stock market has been up in most cases with an average increase of about 11%. Sounds great, right? Well, that depends on how you look at it. Stock market gains don't benefit everyone equally. Lower interest rates can make it cheaper for companies to borrow money, which can help them grow. But here's the catch. Most of the benefits from stock market gains go to the wealthiest Americans. As of 2021, the wealthiest 10% of Americans owned 89% of all stocks. So while you might see some benefit if you have an investment portfolio, the real winners are the top 1%. If you're an investor looking for short-term gains, this could be your opportunity to buy stocks and ride the wave of market optimism. However, as Ben Carlson from the blog A Wealth of Common Sense points out, the stock market cares more about earnings and the broader economy than it does about a few interest rate cuts. So if the economy continues to cool, or if we head into a recession, even multiple rate cuts won't be enough to save stock prices. But what if you're not an investor? What if you're just trying to make ends meet or save for the future? Unfortunately, the benefits of a rate cut might not reach you at all, or worse, they could actually hurt your financial stability. Let's dig deeper into the impact of this policy shift. When the Federal Reserve lowers interest rates, The first place you'll feel the impact is in your savings account. Right now, many high-yield savings accounts are offering interest rates of around 4.5% to 5%. But with this rate cut, those yields are expected to fall. Banks are likely to lower the interest they pay on savings accounts because they can borrow money more cheaply from the Fed, reducing their need to attract deposits from everyday people like you and me. A great example of how this works can be seen in the case of Wealthfront, a high-yield savings account that many people use. Back in November 2019, when the Fed cut rates by 0.25%, Wealthfront's APY dropped from 2.07% to 1.82%. So, expect to see a similar reduction this time around. Your savings will earn less interest, which means your money grows more slowly over time. Is that a deal breaker? Not necessarily, but it's something you should keep in mind when managing your cash reserves. Now let's turn to something even more significant: mortgages. Mortgage rates are directly influenced by the federal funds rate, but the relationship isn't always straightforward. In fact, mortgage rates often begin to fall even before the Fed officially announces a rate cut, because the market is already anticipating the move. That means if you're in the market to buy a home, now could be a good time to lock in a lower rate. But hold on, there's a twist. Lower interest rates don't just make mortgages cheaper, they can also push home prices higher. How? Because when people can borrow money at a lower rate, they can afford to pay more for homes. If you could afford a $500,000 home with a 6% mortgage rate, you might be able to afford a $630,000 home with a 4% rate. So, even though you're saving on interest payments, you might end up paying more for the house itself. This brings us to a critical question: will lower mortgage rates trigger another housing bubble? It's hard to say, but it's something worth watching, especially if you're considering buying a home. The last thing anyone wants is to repeat the mistakes of 2008. Where easy access to cheap credit caused a massive housing crash. So be cautious and do your homework before jumping into the market. One area where you could potentially see some relief is with credit card debt. As of Q2 2024, the total U.S. credit card debt hit a record $1.34 trillion, and the average interest rate on that debt was a staggering 22.76%. If you're carrying a balance on your credit cards, you're paying some of the highest interest rates out there. So, will the Fed's rate cut help reduce your credit card interest rates? The answer is yes, but probably not by much. Credit card interest rates tend to move slowly, and even if they drop by a couple of percentage points, the savings might not be as significant as you'd hope. For instance, if you have an $8,000 balance on a card with a 22.76% interest rate, you're paying about $151 in interest each month. A 3% rate reduction would save you roughly $21 a month. Not exactly life-changing, but every bit helps. However, waiting around for the Fed to lower your credit card interest isn't the best strategy. You're far better off taking steps to pay down your debt aggressively. There are many strategies to reduce your credit card debt, from balance transfers to negotiating a lower APR directly with your credit card company. So don't rely on the Fed to fix this problem for you. Take control of your financial destiny. By now, you might be wondering, what does all this mean for me? Should I change my investment strategy? Should I wait to buy a house or rush to lock in a lower mortgage rate? The answer isn't straightforward because everyone's financial situation is different. If you're an investor with a long-term mindset, you're probably better off sticking to your strategy. Continue to contribute to your 401k, keep your portfolio diversified, and don't make rash decisions based on short-term market movements. If you're in the market for a home, now could be a good time to act. But be careful not to overextend yourself. Just because you can borrow more doesn't mean you should. Run the numbers carefully and consult with a financial advisor to make sure you're making a sound decision. And if you're struggling with debt, take advantage of any rate reductions by using them to pay down your balances more quickly. Every percentage point you save on interest is money back in your pocket. Above all, stay informed. The financial landscape is shifting rapidly, and the Federal Reserve's actions will continue to impact your financial future. Be proactive, stay vigilant, and most importantly, make sure your financial goals align with the reality of the economic environment we live in today. Thank you.